I'm Dave Brinkman, partner in our Schneider Wealth Management practice out of our Columbus office. And today we are hosting our Mindful Money Forum. And you're going to hear from various advisors throughout today's program. We're going to start with Alissa Garcia and get into some more of the behavioral finance topics. And Mike Savage from Charles Schwab has been nice enough to join us this morning. Jason Staley and I will get into capital markets. And as you know, anybody casually observing capital markets, there's a lot happening on a daily basis. Jason and I will, kind of get into that. And obviously, to the extent that there's questions out there in the audience and things you would like us to opine on and address, by all means, please speak up and let us know. And then finally, we did some polling in advance of this webinar, where we reached out to you, the audience, and clients and prospects and friends of the firm and said, hey, what would you like us to talk about? And so I'm going to bring on a series of advisors and more or less addressing the questions that we received in advance of the webinar. So Alissa, I'd like you to come on stage here, if you will, and I'll turn it over to you to kick off today's webinar.
Absolutely. Thanks, Dave. And good morning. Thank you all for joining us. As Dave said, my name is Alissa Garcia. I'm an investment relationship manager and the communications manager here at Schneider Wealth Management Advisors. And earlier this year, we began a video series called Coffee with Alissa, where I interview a broad range of people within and outside the Schneider Downs family. And these videos are meant to answer commonly asked financial questions and to discuss investment and financial planning related topics. So we hope you've enjoyed this series and that you continue to watch the new content that comes out. It comes out monthly, both via email and our social media channels. So if you haven't already done so, please take a moment to follow us. We have YouTube, Facebook, Twitter, and LinkedIn. And you can also sign up for our email communications so you don't miss out on any new content. So today, it is my pleasure to welcome and interview Mike Savage. He's the Senior Investment Portfolio Strategist from Charles Schwab. And Mr. Savage has more than 35 years of investment experience across a wide range of asset classes as an analyst, a portfolio manager, and a client-facing professional. He's recognized for his expertise on strategic beta strategies. And so he represents Schwab Fundamental Index ETFs and mutual funds, all with clients, advisors, and the media. He regularly speaks at industry conferences and shares insights on strategic beta strategies with media outlets that include Investment News, ETF.com, Asset TV, Ignites, and many others. Mike's practical investment expertise, combined with his experience interacting with investors, can provide audiences with a unique perspective on behavioral finance and strategic beta issues in the context of today's market dynamics. Mike, really appreciate you joining us today. How's your morning going?
It's going great, Alissa. Thank you for having me.
Yeah, absolutely. Of course. We are grateful to have you with us. We're excited. You have quite an impressive bio. So if it's all good, we'll get started jumping into the questions.
Sounds good. I heard that bio and I wasn't sure you were talking about me or someone else. I got to tell you, my family's not too impressed. I mean, my kids don't think I know anything.
Well, we're impressed. So hopefully they will be too. But so earlier this month, we posted a video interview with a local therapist about behavioral finance. We discussed the common biases that exist in the financial areas of our lives. And so I'd like to start just by reviewing where our biases come from and how the human brain has a big influence on an individual's investor biases. So would you please provide us just a basic overview? How does our brain contribute to these biases?
Sure. And as you mentioned, these behavioral biases, investor biases are really elements of human behavior that affect all of us as investors. And as you point out, they really stem from two portions of the human brain. One is, as shown here on the chart, the limbic system, which is in the center extending to the rear of the human brain, and it controls our impulsive reactive behavior, the fight or flee reaction. is driven by the limbic system, and that's one big key driver to the range of investor biases that we see. The other portion of the brain that influences investor biases is the prefrontal cortex, which resides more in the front of the human brain, and it tends to respond to observations or processing of some data. And it's a different type of bias, and we'll go over that, but it also comes from a portion of the brain. As you mentioned here and show here, that it turns out in the history of the evolution of the human brain, the limbic system was developed first. The brain was developed from the back to the front. And it's one reason why signals we get from the prefrontal cortex, which was developed after the limbic system, often can't override the signals we get from the limbic system. So I promise this is really the only physiological chart in this whole presentation. We're not going to have a test on this or anything like that. But suffice it to say that there are two big parts of the brain that drive most of the investor biases that we see.
Well, just like there's two parts of the brain that drive it, I think investor biases can frequently be grouped into two different categories, each corresponding to signals we receive from the brain. So could you identify these two categories and give some examples of the common biases that fall within each of them?
Sure, that's exactly correct. We tend to categorize the broad range of investor biases into these two categories. One is the emotional group of biases and responding to the idea of I feel the market's had quite a run here and it's due for a downturn. So maybe I'll take some money and move it out of the market and put it into something safer. That's an emotional type bias. The other group is the cognitive type bias, which is processing some observation or experience. A broad case example might be, the Federal Reserve is raising interest rates. That means that at least they think that the economy might be subject to some inflation. Well, maybe I'll look for some kind of inflation hedge as a result of that observation. So those are the two broad categories. On the emotional side, which by the way is driven more from the limbic system than the prefrontal cortex. Remember, the emotional is responding to I feel, more of a gut reaction. Some of the more common emotional biases are regret, failure to make an investment based on the regret of a past investment that didn't work out for you. Loss aversion, playing it too safe and not taking a reasonable level of risk given your circumstances. And this is one we see quite often today, overconfidence, having an unreasonable level of confidence in one's own ability in terms of making investment decisions. On the second group, the cognitive group, remember, responding to I think, and often in conjunction with the processing of data or observations. Some of the more common biases there are anchoring, making a decision to buy or sell or measuring performance based on some fabricated data point. And I'll be honest, I'm guilty of this, or was, for many years. I used to make individual stock selection decisions based on the previous 10 years of a stock price. And that never really worked out for me. And I've come to learn the hard way. Now, I've spent my life in the investment business. I've come to learn the hard way that stocks don't necessarily trade in 10-year cycles. So there have been many stocks where I bought and sold based on a 10-year cycle that have gone up, I don't know, 5-fold or something since I sold it. And I missed out on that because I was waiting for it to get back to a 10-year low end. That's a classic case of anchoring. Another one in this category, cognitive biases, is herding. A lot of investors getting into some kind of investment when they don't really understand what it's all about and simply in it because they think everyone else is in it, or maybe they hear about it on the news networks or what have you. And the last one that I might spend a little time on is this issue of availability. And broadly, availability is a bias that means you're making what should be a long-term investment decision based on information you're hearing right now, which is by nature short-term. And a classic case, and a lot of people don't understand this, is CNBC, and the other financial news networks, because a lot of people are making decisions based on what they hear on CNBC today. And CNBC may not really be acting in an investor's long-term best interest.
No, definitely. And it's so when the headlines pop up, they can often be very convincing, and they tend to, hot stocks to buy, right? For just a small reason that it'll attach to it. And I don't think a lot of people really dive into the research behind that, right? It's like, well, Jim Cramer said it, so it must be a good stock to buy.
That's absolutely correct. And I'll just quickly interject that, maybe it's worse when the market's in a downturn, right? Because think about the people and the tone that they have on CNBC. Every talking head, for lack of a better description, and to be honest, there are many Schwab senior people that are invited on to CNBC. I don't mean to disparage everybody who comes on CNBC, but in a market downturn, many of them say things like, yep, I saw this market turning down and I went to cash a month ago. You see them time and again say that kind of thing, and that really plays on people's emotion and often gets them to act in a way that's not in their best interest.
So a third section of biases that I find very fascinating are generational and learned biases. And I think for our audience, these are the biases that are either learned from our personal experiences, what we're taught by our family, in our upbringing, also from our age and the social norms that exist within our society around our generations. So Mike, how have you seen these biases impact people throughout your career? And can you elaborate on some of the differences that exist between generations?
Sure. And, it's well understood that an individual's investor bias are at least partially driven by their demographic class. And we do see some general investment themes among the investor classes. It's hard, frankly, to make blanket statements about any demographic group and how they might invest. For example, I'm the youngest class of the baby boomers, born in 64. Am I going to invest like someone who was born in 46? Perhaps not. Nonetheless, we do see some themes that we can kind of discuss. And in the interest of time, I'm only going to focus on two of them. The baby boomers, again, I'm the youngest class of the boomers, and the millennials. And the millennials are surprising us. You see that millennials are showing to be far more conservative and have as their preferred investment vehicle cash. You think the younger folks are going to be more of a risk taker. And certainly some are. But on average, we're surprised at how conservative they're showing us to be and have as their preferred investment vehicle. We think there are a couple of reasons for this with regard to millennials. Many of them expect to have many more employers than their parents did. Many of them are taking jobs in high-risk industries and high-risk companies. And for that reason, many millennials believe they're going to have significant periods of unemployment, some of it voluntary because they want to travel around and take time off, but also involuntary because they're taking jobs with higher risk industries and higher risk companies. Another factor we think driving this higher level of conservatism is the market environment they've seen. These two charts shown here show the S&P 500 through each of the demographic classes' so-called formative years. They're not the same exact years. However, the period high school, college, job market, family is represented here for both a millennial, which is on the right, and a baby boomer on the left. And just take a quick look at it, and you can see there's quite a bit of volatility here on the millennial chart. That's quite a bit of up and down. That by the way, extends from the late 90s to the early 2010s, like 2015, 16. And let's talk about that real quickly, right? So, even the older millennials were not investors during the tech bubble and crash of the early 2000s. However, many of them had parents or had friends who had parents that worked or invested in the tech industry. So we think at least some of the millennials were aware of fortunes made or lost, right? Now, moving forward into the 2005, 6, 7 period, you might all remember, if you could fog a mirror you could get a home mortgage for $500,000, depending on the particular market. Many of the older millennials became first-time home buyers, and some of them found themselves underwater on their home and mortgage, having a home currently worth less than the mortgage that you used to buy it. And so that's a lot of stress. Now, obviously, markets have come back from those two episodes, and if you were to extend this chart further, we've seen that it's come back even better than that. So, nonetheless, we think that this is one big input as to why millennials are showing us to be a little more conservative than we thought. Baby boomers, on the other hand, just quickly look at this other chart on the left. There was some bumps in the road there. We didn't think there were bumps at the time. I remember the crash of 1987. I was just graduated from college and working in the investment business, and I thought that was a very dark day. But we recovered relatively quickly from that, and since that time have done nothing but go up. So boomers are showing us to be willing to take an appropriate level of risk and to think longer term. Now, to be fair, certainly many boomers are already in retirement, and many others, like myself, are approaching retirement. So, time is of the essence for a boomer, more so than a millennial, and that may also contribute to the idea that they're willing to take an appropriate level of risk and think longer term.
Well, and we certainly try to meet with not just our clients, but also their young adult children. So we can get started with financial planning, get them invested in 401ks, right? Start having these financial conversations early on to try to break, again, some of those generational and learned biases that have come from experiencing all of these events. So we can make sure that not just our clients, but also their children and their grandchildren get started on the right track as well. So when you brought up risk tolerance, just because of, the big, how well can we handle the big drops, all of those things. And we find ourselves this year, of course, in a period of extreme volatility, which we haven't really seen for a while. Understandably, emotions tend to run high and can often take over our mindset, even if we tend to be pretty even keeled. But one of the phrases I like to use with my clients, and I have been in meetings, is let's focus on what we can control versus what we cannot control. And we review the items, they're listed up here on the PowerPoint, but what's your asset allocation? And that correlates to your risk tolerance, how well you can withstand those ups and downs and the bumps in the road, especially when they're big bumps. We can also control our saving versus our spending. Our short and long-term financial goals and projections. And perhaps I think the most important one right now, like we brought up before with the media, is we can really control what we choose to expose ourselves to. In an age where we are just bombarded, whether it's news or social media, with negativity, really big and scary headlines that often don't correlate with something big and scary. But of course, when they pop up in a red headline with a lot of capital letters and exclamation points, it can rock us a bit. But can you elaborate on these items? And please feel free to add anything that I missed if we can define, what we can control versus what we can't.
Yeah, I think this is a great theme. I firmly believe in this idea. And one that a couple of issues that I want to talk about. One of the things that we recommend for clients is to try and tune out the media, or at a minimum, try and diversify your media sources, right? Much like you would anything else. So I'm continually shocked at how many clients I see, particularly those that are retired and have the time to do it, how much time they spend in front of the financial news networks like CNBC. Our suggestion is to tune some of that out. To be honest and fair, we as a firm, Schwab, and we as an industry, financial services, have contributed to this issue, right? We all advertise on CNBC and the others. If you walk into one of our branches, you happen to see CNBC typically on a very large television blasting at you. So if it were up to me, we turn all those off. It's unfortunately not up to me, but I'm working on it. A related topic to this, very closely related, is the idea of trying to take the emotion out of investing and be aware that there are many sources, including the news, that are really coming after your emotion. They can really impact you there. So one quick story. I was traveling in Southern California and I went into a Schwab branch and was asked if I'd speak with a client. I soon found myself on the phone with a Schwab client who was absolutely distraught. He was distraught because he'd been a lifelong equity investor, been in the markets a long time. He had just gone to cash amidst a 15% market downturn. He saw markets going down. He was watching CNBC, and he got caught up in the emotion of people on CNBC and others saying that they had gone to cash. So he thought that's what he wanted to do. Well, the market had turned around. It was now up 5%, and he'd lost out on that 5%. And that may not seem like a lot to most people. And what's the big problem? But his personal circumstances had just changed, coincidentally. He felt he and his wife had adequate assets for retirement. However, his adult daughter had just gotten divorced, and his adult daughter and his granddaughter were now living with them. And it looked like he and his wife were going to have to support them for the foreseeable future. Now his assets didn't look so adequate, particularly in the face of a 15% decline. So I think it was a combination of those factors that forced him to sell and go to cash completely. What he wanted me to do was to tell him when he ought to get back in. And, I don't know what stocks are going to do next week, next month, 5 years from now. I have no idea. But I do know this. If I wanted to be in equity markets longer term and I was sitting on a big pile of cash, I'd carve it into buckets, 5, 8, 10 equal buckets, and put it to work over an extended period of time. A year, 2 years, 3 years, 5 years, put it back into work, particularly if I was uncertain about the current level of prices or was concerned about it. And that sounds very simple to the folks on this call. It is simple. It's classic dollar cost averaging, right? But so many people forget that stuff and get caught up in the emotion of it all. And, that fellow didn't do a hallelujah when he got off the phone with me or near the end of it, but the tone of the conversation got a lot better near the end of that call than it did at the beginning. So at least he had some idea, a potential plan to get back into the equity market, which is what he wanted to do. So taking emotions out of it is another one of our suggestions. And it takes many forms, but certainly one of our suggestions to try to better acknowledge, work with, recognize the various investor biases and at work in our own decision making.
Well, that story actually segues nice into something else that I wanted to bring up, because we know that behavioral tendencies, they can greatly affect the outcome of financial plans and of portfolios, just like in your friend's situation. And I know Schwab has created a program for financial advisors called Diagnostics. It's a framework to help advisors incorporate behavioral finance into their practices, to elevate the client experience by identifying and mitigating these behavioral and generational biases that can often stand in the way of clients achieving their long-term goals. So can you tell us more about why and how Schwab developed this program and how you were involved?
Well, there are some very senior people at Schwab that have long followed this issue of behavioral finance and how it affects investors, often to their detriment. And as a result of that work, we developed this program several years ago, well before the pandemic. And what it really does is it's got a couple of parts. What's shown here is the advisor guide. Another big part of the program is the investor guide. And we hand this out, or an advisor can have both, and the advisor can hand out the investor guide to investors, and investors will go through and go over the information that I sort of highlighted today. The investors do not have to listen to a presentation like this one. They can simply read the first 4 or 5 pages of this investor guide that works out quite well and goes over all the information and more than that I described. And then they go in and identify, what kind of bias they're likely to have, more of an emotional or a cognitive bias. And then they'll identify which demographic class they're in, because as I mentioned, a person's demographic class influences the biases they have. And then they'll go through a list of 10 ideas. I went through 2 of them. One is tuning out the media. We call it the media diet. And one is trying to tune out emotions. And we call that the emotional override. 10 ideas of things we can do right now, all of us, to better understand and work with the biases at work in our decision making. And what's happened is clients have looked at this as a friendly, no risk report card. And they've really gotten into it. Frequently, they'll call us back and ask for extra copies because they want to share it with their spouse, or they want to share it with their kids and get their kids to fill it out. And that leads to conversations between spouses, that leads to good conversations between parents and their kids, and often leads to great conversations between spouses, parents, and their advisor. This has happened time and again. The advisor guide that's highlighted here describes what to do with it. All right, so now we have these investors who identify as having more of an emotional or a cognitive bias. They go on to identify specific biases at work in their own decision-making, like a loss aversion or anchoring, as I mentioned earlier, and how an advisor might use that information to tweak the portfolio a little bit to accommodate an individual's investor bias. And why might you want to do that? Well, here's a classic case that we see time and again. You know, we have maybe a retired couple account, and they've been married a long time, 40 years, and either the husband or the wife drives most of the financial decision-making for the couple. Unfortunately, that spouse passes away. We all understand the surviving spouse can be something of a deer in the headlights. We also know that many times the surviving spouse leaves the previous financial advisor. That's never a good thing. But what if we'd gone to the effort as advisors to ask each of the couple to fill out this behavioral finance workbook? Well, the advisor can say, listen, you've demonstrated maybe a higher loss aversion, and we're going to use that and modify the portfolio a little bit, maybe taking as appropriate, maybe taking assets out of riskier assets and putting them something in safer to accommodate the individual's investor bias. And that's one example of dozens that puts this to work. And the advisor guide, as I mentioned here, goes into more detail on how to exactly put this information that you've gathered from the clients to work.
Mike, you've been a wealth of information. We appreciate to have had the opportunity to meet and interview you. Is there anything else that we haven't covered today that you'd like to share with our audience?
No, I think we did a nice high-level overview of it. If there's certainly information, please reach out to the folks at Schneider Downs, and we can get this material to you if there's interest. We can have another conversation about it, all those kind of things. So I certainly appreciate the opportunity and the time to come on the presentation today.
We appreciate you. Thank you again. And next up, we're going to dive into market commentary with Chief Investment Officer and Partner Jason Staley and Partner David Brinkman. We sent out polls, as Dave mentioned, prior to this webinar to determine where your greatest concerns lie. So please stay tuned to hear Jason and David's thoughts on those topics, followed by an opportunity to ask live questions to our advisors. And again, please be sure to follow us on all of our social media pages, sign up for our email communications if you aren't already receiving them. I would encourage you to go back and watch my video interview with Nancy Bells on behavioral finance, and also keep an eye out for the next 3 videos with her in October, November, and December. We're going to talk about topics like retirement transitions, marriage and finance, and children and finance. So Jason and Dave, take it away.
Thanks, Alissa, and Mike, thanks for joining us. I couldn't agree more. As advisors, as Jason's coming up here, we're trying to strip the emotion out, right? These are financial decisions, and as much as possible, let's take the emotion out of the equation and try and make rational decisions, when it comes to investing. So, Jason, I thought it might be helpful. I'm going to have a little fun with this segment, right? And you and I have known each other for quite some time, even before we came to Schneider Downs. And, I get questions from my clients. Hey, I really enjoy the back and forth with you and Jason. Do you guys like each other? Because it seems like you just challenge each other. And I thought I might give the audience, knowing that we might have some new faces that maybe haven't seen some of our market commentary, maybe a simple breakdown. You and I have a natural dialogue, right? And we have natural opposites. You're from Northeast Ohio. I'm from Southwest Ohio. I'm an Ohio State Buckeye. You are not. And worse, you're a Michigan fan. You're a Browns fan. I'm a Bengals fan. You have a tendency to be long-winded. I can be short and sweet. But where we do align we both have a passion for capital markets, and I think we both love what we do for a living. I'll give you a chance to respond there, since I kind of threw that one at you.
I would like to say that I'm an enlightened individual when it comes to the college athletic teams that I support, in addition to my alma mater, Mercyhurst. I am a big Michigan fan, and if you're only as good as your last game, talk about the rivalry again in November. But no, I think that there's a natural back and forth that comes along with colleagues that have a lot of trust in one another. And I think, for us, especially during times of volatility, you need to be able to have not necessarily adversarial viewpoints, but what you need to have is open dialogue amongst people that maybe some of the core convictions are similar, but there's, I think different viewpoints need to be represented. And so I think our banter could be characterized as high intensity, but always trying to give our clients a perspective that we think that they need, which is to hear all sides of the story, and hopefully that gives them the comfort to know that our viewpoints are really helping them achieve their goals and objectives. And I think that's what we're in this for, is to really create those kind of long-lasting relationships where the glide path and the trajectory of the financial plans we show them initially as clients, we're there to see it through to the end.
Let's maybe play off of what Alissa and Mike got into a little bit, and then for the audience, we're going to get into capital markets. There's a ton of volatility, ton of uncertainty. You're seeing headlines come out on a daily basis that are creating even additional anxiety. So we're gonna break all that down. But when we're working with clients, I just found myself nodding a lot to what Mike was saying, right? That fear sells, right? I think he did a nice job of he gave the CNBC the once over a couple times there. But basically, turn off the television. You don't need every last data point. If you're making decisions based on whatever, as an example, right? There's housing data that came out this morning at 8:30. I mean, there's no shortage of data every day. And, in my experience, most investors just don't need that. So maybe as the first question for you, that balance between, hey, there's a lot of short-term stuff, but, how do I maintain that disciplined approach and take the emotion out?
I think that the CNBC has done an admirable job in bringing, I think, financial awareness to a large group of Americans and kind of the kind of audience abroad, and I think they should be commended for that. I think some of the personalities and some of the articles that you see are just like everything else in media, right? You're trying to drive clicks. This is a fully online or kind of visual way of delivering content, and you need to be able to attract advertisers, and a lot of times that leads to what we'll generally refer to as clickbait. But I think in general, CNBC, if done in proper doses, I think can be additive. But like anything in life, right? There is such thing as too much of a good thing, and I think that CNBC can certainly do that, but it's it's the nature of us as human beings, right? We tend to seek out things, and especially when things aren't going right, that leads to kind of a propensity to really try to read more and get more data points, and that can become somewhat of a self-fulfilling prophecy. So I certainly agree with the fact that sometimes what CNBC writes and delivers is not necessarily always in the best interest of a long-term investor.
Right. So here's what I'd like to go through with the audience today. We've got a series of charts, data points, conversational pieces. What I'd like to do is maybe start really big picture with this first chart, right? So maybe for the audience, this is, you'll hear this called the quilt chart. What this is doing basically is showing you big picture, right? Big picture asset classes the last decade. So if you're at the top of the page, that was the best performing asset class. And if you're at the bottom of the page, the worst performing, and kind of everything in between. Jason, kind of what this chart tells me, and then obviously I want your perspective. Capital markets bid up assets, and they may bid them up over a series of years, right? So I'll pick on small cap, right? That purple box in 2012 gets bid up, nice returns in 13, 14, a little bit more muted, but still staying up there. But inevitably, you'll see that purple box bounce. The other one that sticks out to me is commodities, basically underloved for the majority of the last decade. And here you are in 2022, top of the stack. What it tells me is assets get bid up, get bid up, get bid up. At some point, they get too expensive and they take a haircut, and we're going to start the cycle all over again. And that cycle might play out over, 5 to 10 years, depending on where the economy's at.
Yeah, I think that this chart certainly does show that volatility. What I would kind of, the year to date, obviously, as David kind of referenced earlier, the market has moved a bit since we got these slides approved by compliance. So kind of the year to date, now you're seeing kind of the S&P down 20, small caps are down 20, internationals down 22, real estate's down to almost 25, bonds are down kind of 12. So, generally speaking, the year to date column is kind of directionally, but just before I kind of comment on that, if you're looking at the chart on the right hand side, as I often joke around, they don't let the chief investment officer be the chief compliance officer for good reason. And
very good reason.
Just wanted to,
yes,
very good reasons. Yep. So kind of let that be known. But yes, I think what you see here is that this quilt is essentially exhibit number one of why you want to have a diversified asset allocation, unless you think you're capable of kind of picking the very best assets, the asset classes every year. And in years like 2015 and 2018, where municipal bonds are the best performing asset classes, that tends to be something that you don't think you're going to see very often. But whether we're talking about emerging markets or small caps or certainly commodities, you certainly see that there's volatility. And Alissa and Mike, talked about this in the last session, but cycles have gotten longer. I mean, you talk about commodities being underloved. You're talking about a negative rate of return from the great financial crisis up until 2021. It's certainly, you see these kind of longer cycles kind of present themselves. And I think that can lead to some behavioral issues, like I only need to own the S&P. Okay. But then there's a year like, this year where you're cut, you're down almost, 20%, a little bit over 20%. And I think that mindset can be somewhat problematic, and why we certainly believe in having, a diversified basket of risk assets. And we'll always be apologizing for not holding something, but we're never going to own 100% of the worst thing, and we're never going to own 100% of the best. And we think that is the best way to, on the investment side, right? We're going to talk about this as we go on, but there's the investment side, there's the financial planning side. But on the investment side, owning this diversified basket of risk assets is the best way to get our clients to achieve their goals and objectives.
Yeah, I mean, I think we've been looking for that manager that can find the best asset class every year. We just I don't know if we're just not looking in the right spots. We've yet to find them.
I think they're out there. They just won't. A lot of these guys have converted into family offices, and the Stan Druckenmillers, and those folks, David Teppers of the world, right? They're and to quote two famous guys from Pittsburgh. Those guys are not open for business for us. So
right.
Certainly need to own those diversified baskets for sure.
All right, so that was maybe the last decade. Now let's zone in. Like let's lock in on 2022. And to your point, whenever you run these charts, they become outdated as soon as we put it in the materials, right? I mean, this chart's only 8 days old. It's got the S&P 500 off 16, 17. We're probably off closer to 20, to your point earlier. Mm-hmm. You've got, maybe let me slow down here and break down these indices just to set a baseline for the audience. So you've got the Bloomberg U.S. aggregate. Think of that as the proxy for taxable bonds. Taxable bonds being, generally speaking, safe, secure, limited volatility, limited bounce. You grind out and you clip some coupons, and we're going to get into it, right, in terms of where yields have gone. But historically, if you could grind out, I don't know, what we used to say 2 to 3%, you'd love it, right?
Yeah, I mean, I think when you're looking at the ag, that's U.S. Treasuries and agencies. It's investment, it's all investment grade. and really kind of what you would generally consider to be the safest investments that you can hold. And they typically have a negative correlation to risk assets. And we'll talk about that.
We add in, sorry, cut you off. We add in high yield, right? That's just a little bit more juice on a fixed income play. And then we get into, whether it's domestic, you look at the S&P 500 largest stocks based in the U.S. Russell 2000 is more or less a proxy for U.S. small cap. And then we added in 2 additional international, right? So MSCI, ACWI, XUS, that's a mouthful. What is it? All country world index, exclude the U.S., so basically global markets. And then we also give you emerging markets. Jason, I think, in having talked to clients here, I think, yes, capital markets, specifically stock markets, have been volatile. But I think the underappreciated side of this is obviously seeing the ag off 12, something we haven't seen in 40 plus years, right? I mean, previous to that, what was the worst ag year? Off 3, 4, maybe 5?
I think that you don't typically see that, and I think a lot of it has to do with the major drivers of why risk assets in general have really struggled, right? And so for the last 40 years, my parents, Bruce and Linda Staley, they got married in 1980. They got a mortgage. I think they were making like a combined $22,000 a year as teachers, and their first mortgage, I believe, had like a 16 handle on the interest rate.
Yep.
And I think that was kind of like peak. That was just like right as Reagan and Volcker were getting going. And then from that point on, you saw this, this declining interest rate environment. And in addition to that declining interest rate environment, where I think the 10-year got as high as, in the teens before Chairman of the Federal Reserve Volcker and under President Reagan's administration, really kind of flexed their muscles and really kind of tamped down the inflation. What you saw was not only did interest rates go from 16% on the 10-year to call it a half of 1% during COVID. So when you think about that secularly declining relationship, right, that secular decline in interest rates, it also coincided with a major decline in inflation. So you had kind of this 40-year tailwind where inflation was falling and so were interest rates, and they kind of go hand in hand. And as a bond, just to kind of review for those of kind of the first owners, the way that a traditional bond works, it's like a seesaw. As prices go up, yields go down, and then when yields go up, prices go down, right? So it's
and
kind
we've
of this
had
traditional.
We're going to get into yields in a second, but that's what we've had this year, and that's how you're off 12.
Right. And so traditionally when let's just take whether it's the great financial crisis, whether it's the sovereign debt crisis in 2011, energy cracking in 2015, 2016, when the S&P 500, let's just say declines 10, 15, 20%, like it is prone to do, that's the reason why you earn the equity risk premium, because it's risky to invest in stocks. You would see stock prices fall, and then correspondingly in something like the Barclays Ag, yields would decline because people would be fleeing into bonds, right? They would be going into the safe haven assets. And that is traditionally why a 60-40 portfolio works, because if your risk assets are in trouble, right, your U.S. stocks, large, mid, small, international, developed, emerging, even high yield bonds, while those are having their time in the barrel, so to speak, your high quality bonds, whether that's the ag or high quality municipal bonds, typically they appreciate in value because investors are seeking that protection. And that has been the one anomaly that we've had to deal with this year as asset allocators, investors, and dealing with, and most importantly, clients, right? Because this is your life's work. This is your life savings. We haven't really had that traditional ballast to the portfolio. Have bonds held up better than stocks? Sure, they have, but that spread when you're looking at the S&P down 20 and the ag down 12, that's not going to create a lot of comfort in a portfolio. And really the reason the stocks are down, and I think that the U.S. Federal Reserve just raised the interest rates by 0.75% or 75 basis points for the third straight time in a row. And you've essentially taken what was a zero interest rate environment, and you've taken it to what the Fed is now saying might be a 4% is the new neutral rate. So that's, a 400% increase, right? If you think about, from where their policy targets are, and a lot of it has to do with inflation. And it's the perfect sequence is that when you have when you throw the kind of money that the United States government and other world governments put into the system to combat COVID, right? And not to relive the March of 2020, but when you put the global economy into a coma and you don't want to create an economic calamity, a lot of money was printed, right, put into the system to make sure that economic activity stayed at a reasonable level. And that's why you saw, in the kind of the mini recession that happened in 2020, incomes rose in a recession. And that has never happened ever. Typically, people are losing their jobs. And in this case, not only did less people lose their jobs than originally expected, the ones that did lose their jobs got their jobs back more quickly. And you had these government stimulus payments that kind of came through. All of that money, all of those, whether it's services, capital goods, all that demand really spiked, and it created stresses on the supply chain. And David, you'll go over this chart, but inflation, for you and I, right, who have basically our entire lives, we've seen declining interest rates and declining inflation. This is a long cycle that the trend seems to be reversing. And you can walk through the CPI slide, but this is something that we have not had to deal with, and I would say, a little over 40 years.
Yeah, let me, just for the benefit of the audience, right? So what we're showing you here, CPI, or Consumer Price Index. So the headline number, right? Let's play off of what Mike gave us earlier. The CNBC tagline: inflation super hot, right? And it's just going to be there in red and just pounding at the bottom. In August, we got a print of 8.2. That followed a print in July of 8.5, which you can see here. The one you can't see, right, is when we touch 9.1 in June. All of these inflation numbers are numbers we haven't seen in 4+ decades, right? Jimmy Carter was running in the White House, if you will. And then, I don't know how you feel about these, right? There's other ways to slice and dice this, but I don't really care what metric you look at. Core CPI, okay? So strip out maybe some of the more volatile stuff. You look at food and energy, and we're going to get into that here, right? Because when you start talking capital markets, you're going to start to talk about the things impacting the food and energy and global supply chains. But, we got our most recent data point yesterday from the Fed, right? And they moved, to your point, the third 75 basis point increase, third in a row, I should say. So now the Fed funds range is 3 to 3.25, and public markets basically are saying, look, that looks like it's going to 4.25 by the end of the year. So maybe give the audience, hey, why is inflation so problematic? And the Fed is trying to be as vocal as possible, saying, look, if we end up going into a recession, so be it. We got to get inflation to heal.
Well, I think part of the and I'll take it back to Chairman Volcker, because I think that when you go back and you read his, what he was writing at the time, and he's one of, the people that I've really relied on in terms of trying to go back and get knowledge about inflation. He broke inflation in the late 70s. Maybe just give people context, right? Yeah. So there were a lot of things that were going on. Quite frankly, that were different than what they are today, and I don't want to give everybody. Right. A history lesson. As David said, I can be long-winded, so I'm going to try to be pretty short with this. But from kind of, you look at the kind of the ending of the Vietnam War, the oil embargo, things going on, with the Iranian hostage situation. There was this, energy and food. There was this, we kind of thought we broke it, and there was a big policy mistake. And Dave, you can see that in the chart. In 1974, the Fed basically did a mission accomplished victory lap, and it rose again. And that's kind of what Jerome Powell is looking at the 70s and saying, like, we're not doing that. We're not going to go from 12 to, call it 5 on headline inflation, then have that headline number, which is the light blue, spike all the way back up to 15. We're not going to do that. So we'll keep rates higher for longer, we'd rather have a policy mistake in that we put the country into a recession, and what kind of recession, we're still trying to figure that out. But we'd rather have that than the alternative, which is kind of this double dip or this head fake that you see in the first part of this chart. But really, what becomes problematic about inflation, what Chairman of the Federal Reserve Paul Volcker did, he was Ronald Reagan appointed him to be Chairman of the Federal Reserve. His worry was once inflation gets into the system, if you do not get it out, it tends to move around and it's really sticky. And that's kind of what we're seeing right now, where there were different drivers of that inflation number. A lot of, the first part of this, it was kind of capital goods, right? You have this stimulus payment. Let's go buy a new iPhone. Let's go buy a new car, right? Now, I think everybody has seen the stories. If you've tried to buy a new car over the last 2 years, it's been incredibly difficult. Home prices have rocketed up. And now, so now as capital goods, inflation is somewhat receding, supply chains are somewhat normalizing there. Now you're seeing inflation in the service sector. So if you go to a restaurant, you might see like in addition to an automatic gratuity charge, a retention and benefit charge. And I was just in an airport in California. It was the first time I had seen it. I was grabbing a burrito at a California pizza kitchen in the San Diego airport. And they had a 2% surcharge that was used for employee retention and retention and kind of attracting them. And that's the first time I had ever seen it. But you're starting to see that inflation move into the service sector. And the reason that Jerome Powell, again, wants to get this out is because if you look at, if you're a company, you're reporting public earnings, and let's just take, your Pepsi, where you're going to have your commodity costs are going up, your people costs, your human labor costs are going up, your shipping costs are going up. At a certain, in the beginning parts, you can start to, pass those costs on to the consumer, and they will take it. At a certain point, you hit a threshold where you can't continue to push that inflate or push those costs onto the consumer. That comes onto your balance sheet. And that's what we're starting to see play out in the public markets when these companies start to report earnings, and where in the first quarter, hey, they were able to pass through almost all of the inflation, all of their cost increases, similar to the second quarter. Third quarter earnings, what we expect to see is more of these charges or these quote unquote earnings misses related to inflationary pressures that the maximum has been, kind of been breached, where they're no longer able to pass through those costs.
All right, so let's say we got another 15, 20 minutes. I'm going to pick up the pace a little bit because I want to get into capital markets. But we gave you the Treasury curve. So again, I'm going to set the stage, add in anything you'd like. What we gave you is basically, where were we at the end of last year? And maybe in layman's terms for the audience, what is the Treasury curve? So let's go to the 2-year. I give my money to the U.S. government for 2 years. At the end of last year, they had said, all right, Dave Brinkman, you get 0.7% of interest for the next 2 years, and then we give you your money back. And then you could jump all the way out to the far right. If I give the U.S. government my money for 30 years, at the end of last year, they pay me 1.9% each year, and they give me my money back 30 years into the future. Jason, the segue here, right? Inflation's running hot. Most asset classes have taken a haircut, a substantial haircut, depending on where you're looking. And this is where we see the yield curve as of last week, right? A substantial move. We talked about the 3 bumps at 75 apiece from the Fed. This, in my simple opinion, I don't care what asset you are basically resetting the cost of capital to fight inflation. And that is what, in my simple view of the world, led to that year-to-date chart where you see every asset down and to the right.
Absolutely. And also what this curve is telling you is that if you look at because it starts to kind of moderate out, and we can talk about yield curve inversions and what they mean or don't mean. But if you look at the moderation of kind of the 5 years and out, you start to see kind of similar lines. What this yield curve is implying is essentially the Fed's got work to do for the next 12 to 24 months, and then we're going to start to moderate out. And that's roughly what the market is saying is going to take to get inflation back to more normal levels. Now, what normal levels mean, it used to be a 2% target. I think at Schneider Downs and most other places, we think it's going to be meaningfully above that, maybe in the kind of the 3 to 3.5% range is more of a normalized inflation target in the intermediate term.
And I think the other thing this tells me, right, so you heard the commentary yesterday, we already alluded to it. You know, the other dynamic, we didn't really put any data to this, but the labor market, right? I'm just going to take the government stats and say they're right. You could swing it a couple million one way or the other, but basically you got 11 to 11.5 million jobs out there, right? I'll say theoretical jobs. Maybe not all of them. Maybe they're putting a job posting out there, and we just hired 3 new advisors here in the last couple months. But we were being selective. We knew what we were looking for. So there's 11 million jobs out there, and more or less you have 5.5, 6 million people unemployed. So if I'm unemployed right now, more or less the data tells me there's 2 jobs out there for every 1 person unemployed, right? And you hear them talking about this. They're like, look, we need to see the labor market somewhat equalize. And again, I think I'm trying to not use jargon to lose the audience, because there's never simple answers to these things, right? I don't want to sound like it's overly simplified, but you're raising interest to cool off the economy, drive down inflation, and if you go into a recession, typically you see layoffs and you find a little bit more equilibrium in the labor market. I mean, that big picture, right? That's the levers that are trying to be pulled domestically here.
Yeah, I think that it's right now where the U.S. Federal Reserve has put itself is it's really trying to thread a needle, and that's really difficult because typically there are a lot of just countervailing forces here. They're typically not in a normal, kind of a normalized market environment or a normalized recession, and they're trying to balance those things. But yes, they're trying to cool off the economy, which is going to kind of decrease the costs on employers. And try to kind of more normalize and have it go through a business cycle, and it's very difficult because if you've gone into an airport recently, it doesn't look like a recession is out there. Planes are full, airports are full, right. People are still spending money, and that's what they're trying to combat.
So I'll make a hypothetical question. I'm in the audience. Hey, Dave, Jason, that's great, but you guys aren't economists. You're financial advisors. So talk to me about investments. Yeah. So this is the S&P 500 going back to the mid-90s through now, right? The booms and the busts, and Mike and Alissa played off this a little bit. They zoomed this chart out even further to the left, right? But, I think stating the obvious, right? It's been a very volatile year. But, when you start to zoom this chart out, stocks have always been volatile. I'm going to steal your phrase because I think it might be one of your better ones. But generally speaking, stocks go up and to the right over the long run. I think the thing that I've been talking about with clients is, the last 2 years, let's say 20 and 21, generally speaking, we were up and to the right outside of the 30 plus drawdown you saw in March and April of 2020, right? But I remember in the moment saying, hey, Jason, client, like this is not normal. Things don't just go up and to the right and it's a smooth ride and every month we're adding another 4% on. I think I feel like we got a little bit too comfortable and we kind of forgot assets can be volatile over short periods of time. And I might even say short periods of time or years, not months.
Yeah, I think that they're, certainly with the monetary policy, the monetary regime, this kind of low interest rate environment that's been pervasive across the globe since the great financial crisis in 2008 and 2009, investing is certainly seemed a lot easier than we know it historically to be. And, as Mike kind of pointed out, investing kind of comes in long cycles, and that's what's reflected in this chart. You have kind of long cycles of great appreciation, and then you have some very painful drawdowns, and that is essentially how capital markets have worked since the beginning of time. And what I would say, and looking at this chart, is that we certainly think the base case is going to be more volatility, not less. There's some things that we've done in client portfolios to dampen this volatility and maybe take advantage of what we felt like was a likely to be more higher interest rate environment, of what that was going to mean for more traditional risk assets. But right. I think it's very important not to lose perspective in that, where we are now is certainly unique, at least in the last 4 years. But people were saying that about the great financial crisis in 2007 and 2009 and the tech wreck in 2000 and 2001. And on top of that, you had a 9/11, the world going to war with terrorism. there are a lot of these things that have happened over the last 20 years where in the moment they've seemed like we've never dealt with this before. I think, this is where it's important to kind of take a deep breath and understand that there are some strong drivers longer term of corporate earnings, of where the global economy is going in the short term and even into the medium term, like you said. And I think that we need to start thinking in longer in terms of the short term is kind of 6 to 18 months. And the intermediate term is more like kind of 3 to 5 years. And the longer term is 7 to 10 plus years. I think if we start to put that more into that mindset, I think it will help us help us get through this volatility that we're experiencing right now.
All right, so let's play off of what you just gave me there, the longer term approach. So for the audience, what are we looking at? We're looking at, on the left-hand side, you've got the returns for large, mid, small, based on either value, blend, or growth. You've got since market peaks in February of 20, what have the subsequent returns been? Top right quadrant, year to date, where are we at, right? And then bottom right, where are we at since the lows? The second chart, and this is where I want you to go, comparing current price to earnings, right? So the price of the stock divided by the last 12 months of earnings versus the 20-year average. So my question for you is, all right, I'm a long-term investor. I'm buying what Schneider Wealth Management's selling. I'm disciplined. I'm not overreacting. Give me a little bit more when you look at this, and let's say you did want to lean in, right? You understand markets are volatile. Where do you see, and as Chief Investment Officer, how do you size up current domestic valuations?
Well, I think you have to take into consideration kind of the strength of the U.S. dollar and what that's doing as like this global wrecking ball in terms of.
We're going to get into that here in a second.
Okay.
Yep.
So I think that's first and foremost, but that has an effect. One of the reasons that large cap, U.S. large cap stocks are doing so well, right, is they have a lot more kind of exposure to that relative to to some of their small and medium sized peers. I think if we're leaning into anything, we certainly see a lot of value in small and medium sized stocks. I think that first and foremost, that is something that we believe incremental capital. For the long-term investor, those look really good. Value as a style, especially as you get into more of the small and medium-sized opportunities, looks attractive, both to the 20-year average on the PE and when you look at the percentages. And then I think small cap growth, which has just been absolutely crushed. There's a lot of things working against it, but you look at that, and it's the first time you can say that. Small cap growth isn't super expensive, and for the longer term investor, could be compelling. We think, though, again, kind of in terms of asset allocation, the volatility in small and medium sized stocks. There's a reason that you can earn a premium there, right? Because there's volatility. But we think there's a lot of value there. We certainly think that opportunities have presented themselves. The last time that small cap and mid cap stocks were valued where they are now, roughly kind of like 10, 11-ish type earnings, you have to go all the way back to kind of 2008, 2009, and that was a really good entry point for the longer term investor.
Yep. Now let's go outside capital markets. And the one thing you and I talked about as I set the stage here, so you are looking at most regions, globally speaking, from an equity market perspective, year to date, and then 2021, and then we give you some 15-year stats. The thing I want to highlight to people is that local column. Right? Because we haven't alluded to it, but the U.S. dollar is breaking all kinds of records, right? I went to Europe with 3 other buddies, had a great time, probably late 2000s. It was the wrong time to be going, right? The euro was strong against the dollar, and what if we touched parity within the last couple months, right? U.S. to euro.
Yes, it's right now it's trading at a 98 kind of 0.98 euros for every $1. So yeah, it's broken.
So I think that's underappreciated, right? So maybe educate the audience on the impact currency's having when you take your U.S. dollars as a U.S. investor and you go offshore and then you bring it back home. Like, because you can see here, like I'll pick on the EFI. In local currencies, it's off 7. You bring it back home, it's off 19, right? And right. You and I talked about this. And generally speaking, this is why we're not giving up on international equities, because you look at valuations, and even if the currency just flips modestly, it becomes a tailwind.
Right. And I think the one thing that needs to be said kind of before we talk about the relative valuations is that the relative currencies tend to get back to equilibrium. There's reversions to the mean, but they tend to have like really, really long cycles where, one particular currency will certainly appreciate. And that's kind of where we are with the dollar. And I think that, yes, the international stocks and, full disclosure, we've been, we're believers in them, right? We hold them as in a diversified asset allocation, but it's been difficult to hold. And I think we need to, acknowledge the fact that, as investors, sometimes, I know that I certainly have been more excited about valuations there. So really, think that if you do get the, decline in the dollar and you look where valuations are of these, of international stocks, they need a catalyst there, but they're certainly attractive over the medium and long term. Yeah.
You're going to need the geopolitical concerns to die down as well, right? We don't have enough time to
resolution. Resolution in Ukraine. If you could get some kind of stand down in Taiwan and China, I think that would be those would be incredibly helpful. But we really need to start to see the dollar decline. Yeah.
Let's say we got 5 minutes or so left. I wanted to give you the opportunity because for most of our clients, it's not just stocks and bonds. And most of our commentary thus far has been about stocks and bonds. Maybe I'll be your hype man here. Jason, you've done a phenomenal job in building out our private platform. And I wanted to just give you the opportunity to maybe educate some of those clients out there, some of those new contacts that aren't familiar with us. And how do we think of this? Now, I will caveat this with this is generally going to be a larger portfolio, right? You have to be able to bear illiquidity. This doesn't have, we would not be talking to you with a couple $1 million portfolio for things like this. I want to caveat that for the audience if the client's like, hey, how come I didn't know about this? But, generally speaking, give us some thoughts on what we're seeing on maybe the more private or, you might hear it called alternative investments and what we think about out there.
Yeah. And I think that, a lot of this is if you're just, take private equity for kind of the general terms, whether that's buyouts or growth equity or venture capital, you have certain benefits, right? The S&P gets marked to market, a couple hundred million times a day when the SPY trades. Some of the benefits of having private equity are that you have a longer, it's private, it's not getting marked every day. So from an investor psychology standpoint, that is I think it's a feature, not a bug. You're able to kind of execute on your business plan without, people like me and Dave in a previous life, working for William Blair, was an equity research analyst, and you're asking questions of the CEO and they've got these 5 and 10 year plans, capital plans. And you're like, well, what happened in the last quarter? Well, in private equity, you don't really have.
The most recent data point is FedEx, right? FedEx thinks they're still going to hit their 3 to 5 year targets, but look right in front of them, the volume's drying up in Asia and Europe, and the stock took a 20% dump last week.
Exactly, and I think that's that's one of the benefits of having this kind of a piece of your portfolio to the extent that you can bear it in private equity, where you have a longer time horizon. You're able to execute a business plan away from kind of, people like Dave and I questioning whether your business plan are you actually executing on it? And you have this, this ability. And then I think that there's so many of these businesses in the United States that touch us in our daily lives are not publicly traded. And you'd love to have access. I can't tell you how many times I've gone by, like Mr. Magic Car Wash, right? There's a car wash in Pittsburgh. And I always see it full. I was like, man, I'd love to own that. It's not publicly traded. Can't buy it. And private equity gives you the ability to buy some of those businesses that you really like, that we think are attractive. And I think that it's a part of the overall portfolio. There is equity beta, right? It's an equity just like a publicly traded stock. It just has the benefits of being held privately and having to be able to execute the business plan in a manner that is conducive and to the long-term returns of the investor, we think. On the real estate and real asset side, we have been proponents of this. We have been overweight these asset classes in traditional portfolios, and we've talked a lot about our some of our interval strategies that have infrastructure, farmland, and timberland, and then high quality commercial real estate. But we also have options in a drawdown private investments where you're talking about owning, liquid natural gas terminals in Lake Charles, Louisiana. You own hydroelectric dams in Calgary, Alberta. We have this ability to take on kind of this illiquidity and generate what we think are attractive returns that help our clients reach their goals and objectives. And I think for some of our clients, especially who are private business owners, a lot of the private investments, it actually makes more sense to them. When you're owning a real asset or you're owning and operating this business, they have more control.
Theoretically,
Dave,
right?
how many conversations have we had with clients where they'll see a company that doesn't make any money, that was like bleeding hundreds of millions of dollars a year, and it was up 200%, and they're asking us, well, how I can't run my company like that. This is another way for us to earn equity returns, better than equity returns, we think, over the long term. In a way that helps that investor psychology, right? You're a long-term investor. These are illiquid. You're forced to see them through. Again, that helps. And you get to own businesses that you wouldn't otherwise own in public markets. So it's diversification as well.
And I'll hit on this, and then we're going to go to the bull bear, and that'll be our wrap. But we also look for managers that, like set it up investor friendly, keep the fees at a reasonable level, right? Because you could be the best manager in the world, but I come in at the LP level or limited partner level, and the fees prevent me from earning anywhere close to what I think I should earn to take illiquidity.
Absolutely right. You want to have a significant alignment between the general partner and the limited partner.
Yep. All right. And sorry to rush you here, but let's another minute or two on this. So on the left-hand side, all right, let's go back to the peak of January 2020, more or less. What do we need to earn to get back to where we were? If you're going to try and get there in a year, you're going to have to compound at a pretty good rate. 2 years, you're buying yourself a little bit more realistic. 3 years, now you're starting to get into long-term. The S&P 500 is giving you 10, right? It's not been a smooth 10. It bounces around. 4 or 5 years, right? I think that more or less reinforces, guys, you got to take a long-term view. We're not asking to be happy. We get it. Stocks have taken a hit. But where I want you to go is that bull bear and maybe the length and what that tells you.
Yeah. Well, so if you look at the average bull market lasts 51 months, the largest bear market lasts 20, or the average bear market lasts 20 months. So bull markets last, 2.5 times as long as bear markets. But why are bear markets so hard to get through? Because it's so hard to look at drawdowns in your portfolio. I mean, that's you can go back and think about, well, I had to miss my son's baseball game, or I had to miss my daughter's soccer game to earn that money. And then to see it decline, it's really hard. I just stay away from my wife and kids. There are these things that you things that you miss along the way, your spouse, right? And I look at the kind of the 4 to 5 year chart, and I think that the 5 year 5.7%, just to get back to where we were in January, I think is something that's a lot more realistic of a lift than the 1 year. But the bull and the bear market, if you're you're a working mom, right? And you're away from your kids, you're trying to save for retirement, save for weddings, and you see this bear market happen. I mean, and you're like, it's just so hard in the moment. And I think if you zoom out and you just look at it and you say, the average bull market return is 162%. It lasts 51 months in duration. The average bear market return is down 40. I'm not saying that's okay, but it's down 40 and the duration is 20 months. I think that these are things that we can use as advisors in working with our clients to try to put that perspective in, so that we're able to to navigate through these difficult times, to get to calmer waters and make sure that the trajectory of your financial plan is still in reach, and your goals and objectives are still good to go.
Well, Jason, thank you for joining me. Obviously for the audience, we're trying to get this in a 30, 40-minute window. We would welcome a chance to have additional conversations. Please reach out to us. I think you can tell both of us are living and breathing this on a daily basis. So, Jason, I'm assuming you would agree with that. We'd welcome additional conversations. Yeah.
Welcome additional conversations. Please put questions in the chat. David and I will follow up, or someone on my investment team will do the same. So thank you guys so much for taking the time. We really appreciate it.
Well, thank you, Jason. Sean McCann, if you don't mind, I'll bring you on here. And while Sean's kind of coming on, I think the feedback we got from the audience in last year's webinar was, hey, we really liked hearing from your roster of advisors. And, I honestly didn't know you had that many advisors. And, I enjoyed listening and hearing their perspectives. So we've tried to bring on a mix of advisors here. So Sean, Jason and I talked about it, right? Interest rates have moved, and they've moved substantially. I'm going to pick on the 2-year, right? The very liquid side of the curve. You've gone from, again, back to my simple analogy, the U.S. government or U.S. Treasury, give it to them for 2 years. They pay me 0.7% for 2 years. Give me my money back. That number is approaching 4% right now on the 2-year. So as somebody in our investment research team, when interest rates on the short end of the yield curve move that substantially, what are the implications, right? I think I'll give you a lead in. You're rewarding savers, right? I mean, like if you're clipping coupons, you're clipping them at closer to 4 instead of 0.7, and that should feel a lot better, although inflation keeps running hot. Any perspective on that?
Yeah, I mean, I think when people hear interest rates, you hear the term interest rates, they think of two things, fixed income / bonds, or they think of their own personal debt. And on that fixed income side, a lot of investors own that for capital preservation and income. And, as you and Jason already mentioned, although rates have negatively impacted the returns for fixed income this year, with the ag being down about 2.5% year to date. But when we look at valuation of fixed income,
the ag being off 12, not 2.5. But you're fine. Sorry, go ahead.
12. Sorry, I meant 12.5.
Yeah.
But when we look at the valuation of fixed income relatively compared to the last few years, fixed income as an asset class is much more compelling now since rates have risen from their COVID lows. And then on the income side, kind of as you just mentioned, savers are starting to get rewarded for investing in fixed income. And as you mentioned, the yield in the 2-year trading at, I think it's actually at 4.1 now today, which is over 5 times higher than where it was at the beginning of the year, which is quite crazy to think about. But, and that's obviously due in part to raising rates from the Fed. But if we look at taxable money markets, for example, they yield now between 2 and 2.5%, which, in our opinion, serves to be a much higher yielding space to park some extra cash, for example, than savings accounts. And then, if we look at fixed income on an asset allocation basis, risk-free rates at around 3.75, depending on where you sit on the yield curve, and higher yielding corporate bonds, they yield between 4.25 and 4.75. It's not a bad place to be in a volatile investment environment. And then, the other area I'd like to hit on is, if we look at investment grade municipal bonds as well, they currently yield around 3.5% with the taxable equivalent yield, that for those maybe in the highest tax bracket, it's around 6%. So, this yield it's at its highest level that we've observed for, this investment grade index for over the past 10 years. So, overall, yields are up, and fixed income, generally speaking, is not really a bad place for investors to thinking about parking some extra cash at the moment.
Good stuff, Sean. We appreciate the perspective. I'm going to keep this moving along to try and clip this 11 o'clock. So I'm going to have Matt Biggs join us now. So Matt, I think, we haven't referenced it specifically, but the 30-year mortgage interest rate, we play off of what Sean and I talked about, right? Rates have moved substantially. 30-year mortgages just went north of 6% for the first time in 14, 15 years. And I think the question we would have, and maybe it's geared towards the younger investor, simply, Matt, does it make sense to buy a house when your 30-year mortgage is at 6?
Yeah, no, I think that's a question a lot of people are probably asking themselves today if they find themselves in the housing market. And I can tend to be a little long-winded, similar to Jason, so I'm going to try to do my best Dave impression and keep this short and sweet. But there is a reason, full disclosure, that I'm the one answering this question, right? So I actually, my wife and I, we bought a house within the last 30 to 40 days. So I'll use that as a slight example kind of going throughout. But maybe to get at some of the data behind it, Dave, rates certainly feel expensive right now, right? The 30-year just a little bit over 6. Last week, that was the highest it had been in over a decade. So I think there is some recency bias though, right? We feel like it's high. If we kind of zoom that lens out 50 plus years, and Jason said it earlier, he had his parents, I think was the example he used, had a rate at 16%. And I'm sure there are multiple people on this, on this webinar that know of an example of, 10+% interest rates. So historically over that 50-year time frame, the average has actually been 7.75, somewhere around there. So if we're looking today, 6, on a relative basis, kind of over the last 50 years, that's still pretty in line and cheap compared to 7.75, the historical average. So I think, there are a couple things you have to keep in mind. If you're wanting to buy or in the market and you feel like that rate is too high for you, well, what are your alternatives? So you stay where you're at, you rent, or you kind of bite the bullet and you buy at the 6% right now. So in my example specifically, we looked at renting just because we needed bigger space. I've got a growing family. We needed more room. When you did the math at current mortgage rates on a 30-year mortgage versus renting for a house that you need, it was the same monthly cost. So in my situation, it made sense. I felt like, if I'm going to buy, it makes sense. Everyone's going to be unique though. And I think those are the conversations we welcome. So maybe just a couple more points on some of the reasons.
Why don't you go to the long-term benefits that we historically have seen when you tie personal finances to homeowners?
Yeah. So long-term, and if we take that 50-year scope and zoom out even further, the billionaire Andrew Carnegie famously said once that 90% of millionaires got their wealth by investing in real estate, or that was kind of a piece of their overall net worth. If that holds true today, I'm not sure, but I think there are some merits to it. So, number one, you think the forced savings and the paying down debt on a long-term asset that should be appreciating. So if you look at, average housing sales over that same exact time frame, you kind of just see up and to the right the whole time with a couple blips here and there. So not just, paying down the debt, adding to that equity value, but you're also forcing yourself to do that every month.
Yep.
The devil's advocate view would be, okay, well, you own a home. Now, what else comes with that? Again, use myself as an example. Tuesday, our AC goes out. And I'm thinking to myself, wow, is this going to be $5 to $10 within a week of living here? Luckily, it was just the air filter, but these are the things you have to kind of be able to deal with. Third thing is, with that, you can get what's called a HELOC or a home equity line. So that kind of frees up the cash. And that's just a separate way for you to tap into some equity and some cash. And you've got it available if an attractive investment or you need a new AC comes along. And then the last point I'll make is, look, a lot has changed since COVID. I think we can all acknowledge that, and especially people's views on their homes. So home is basically your house and a quasi-office at times, and people are spending more and more time at their houses than they ever have. So I guess to summarize and answer the question, everyone's going to be unique, but I still think in most situations it's going to make sense to purchase, depending on your circumstances.
Good stuff. Thank you, Matt. Greg, we've got two more questions. We got Greg and Derek here. So this is just going to be an obvious statement. Hey, Greg, it's been a super volatile year. I, the individual investor, am struggling. I know the stats. I know long-term is the way I should be investing, but I'm struggling. What do I do?
Yeah, it's a great question, Dave. And I think, if you kind of take a big step back and look at it, it's really a process. And I think each of the steps is kind of equally important. First of all, you really kind of want to consider your own experience and feelings about risk. I think at this point, most people have had some sort of market-based investment at some point in their life or some exposure to it. So I think a real kind of hard, honest look at yourself and a genuine assessment of what's acceptable and what causes excess stress is really kind of, just a very beginning point overall. If even modest market fluctuations make you nervous, you're probably not the type of person that needs to be invested in a very aggressive portfolio, because I don't think it's something you're going to be comfortable sticking with in the long term. And really, we've talked a lot about market data. You and Jason went over quite a bit of data, much of it very good, actually all of it very good. But there's some really good data points out there that will kind of educate you on what risk really looks like and what different types of investing really look like. And I think that's part of it too, saying, hey, what do we mean by risk, right? What does this really look like? If I'm moderate, what does that mean? If I'm conservative, what does that mean? If I'm aggressive, what does that mean? I think that's a huge part of it, is to understand, what are we talking about when we define things as moderate, aggressive, or conservative? I think understanding what risk really is the most important. The assessment really isn't so much about the upside, which is where I think people kind of lose focus in really good markets, right? They see plus signs on the statements. They think this is normal. They get to a point where they see consistent negative signs. They feel like maybe this is not normal. But going into it, understanding what the negative signs might look like, I think is probably more important in the assessment than understanding the positive. And then I think too, a super important part, and this is where a lot of really good perspective comes into play for clients over time, is defining what your short and long-term goals really are, right? So if you're talking about, a pool of funds, perhaps, you've got a 5 or 6 or 7 year plan. Hey, at a certain point, I want to save up enough money and I want to buy a house. That pool of money that you're working on to do that is going to look very different in investment terms than I'm 35 years old and I've got a 401k and I'm going to work till I'm in my late 60s or 70 because that's what I want to do. Those are two extremely different pools of money, and they will have and should have very, very, very different risk profiles. So understanding, A, what does risk look like, and B, what do these long and short-term goals sort of define in terms of what your risk profile ought to look like, I think is absolutely huge. So having a plan and goals and a focus on the longer term, I think creates a lot of perspective on that once you understand what risk really looks like. And I think equally important also to kind of keep the process working, you need, kind of a disciplined approach to what your portfolio composition looks like. It's not good enough to just say, hey, well, I've defined myself as moderate and I've defined the right pool of money for my moderate investment strategy. I'm going to set it and forget it. It's not how the world works. You see, we've looked at all this data today about how much fluctuation there is in the market. The market's proven time and time again that it's a very volatile, cyclical animal. We know this. We can all agree on that. That's going to impact your portfolio. One of the things that you see a lot is when you've got a long, good run in the market, right? A bull market condition, a couple years of positive returns. If you don't make any changes to your portfolio, maybe you started with a 60% equity model, 40% fixed income. After a bull run, you might be 80% equity or 85% equity. That has a very different risk profile than your original 60-40 model does. So if you don't put the work into understanding the goals for the money and doing some systematic and periodic rebalancing with those investment funds, you're going to find yourself sometimes unwittingly in a very different risk profile than you started with.
Good stuff. All good perspective, and apologize for the audience. We're trying to be sensitive here, but obviously, Greg, we could go deeper with clients that might be struggling in the current environment. Last but not least, I'm going to have Derek Eichelberger join us, and then a couple of housekeeping items, and we'll wrap up today's conversation with you. So, Derek, I in the prep, I mentioned that you've got a great example that I think ties a lot of concepts that we're talking about in today's webinar, in that hypothetically, I'm going to play off of what Greg just gave me, and I've sized up. I'm not comfortable in today's environment. I'm off 15, 20%. I was super comfortable being up 25, 30, but now I'm not comfortable. You know what, Derek? I think I'm going to go to cash. And I'd like you to explore that psychologically and from an investment perspective for the audience, maybe to kind of put a close on today's conversation.
Oh, sure. And I've been through a lot of different environments where the stock market went down significantly in my career. And, it kind of comes from that same place when people are down, they want to do something and they think that's in their best interest. So, that strategy only works if you sell out at a certain price and then you're able to buy in at a lower price, right? It's simple. And so, why doesn't that work for people? And this gets back to a lot of what, Mike talked about at the beginning of, how we're wired as human beings. When you're selling out in the current environment. I mean, the market's forward looking, it's looking at what's going on, it's predicting, and it's pricing things, knowing, what we know today. So then, in order to buy at lower prices, we need the stock market to go down further. So what would that scenario look like? It would look like worse news. It would look like worse articles that are being out there, and then it'd be, worse conversations on CNBC. So to have someone that is selling out of a market because they're worried, and then have the fortitude to buy in when the storyline's even worse, is just not something that people do. And I've seen that over and over throughout my career. Let alone thinking about the impact that you'd have of a tax bill that might go along with that, with a lot of embedded gains. So it's not something that we're wired to do. So it's better to, have, as Greg was saying, take a long-term perspective. If you've been doing things like rebalancing, you've been taking risk off the table at those times. But we all want to, be in the market when it's going up and not be in the market when it's going down. But if you're a long-term investor, you're inevitably going to have these time periods. And, it is actually better to do the reverse of what you think. And that is to start systematically, whether it's dollar cost averaging or doing some rebalancing, start to buy the things that are now cheap. And it's just, it gets back to all this behavioral talk that we're discussing, which is, people don't have bad outcomes because they haven't, found that next Bitcoin or that next, stock that's going to, it's because of how they react to different market environments and the decisions that they make. The behavioral things are the biggest issues for long-term success.
And maybe in closing, I'll add on maybe to yours and Greg's piece. Look, selfishly, we are financial advisors. So this is not a plug for Schneider Wealth Management. It's maybe a plug for just a valued advisor, period. An advisor can help you with a lot of what Greg and Derek just talked about. We're fortunate enough to work with really successful people that are really intelligent, and they still want us riding shotgun. Either, hey, look, I don't have the time to do it. You're a third-party advisor. You're unlikely to get emotional because this isn't your money, and you're going to think more rationally and just kind of shoot me straight when I'm getting off the rails. So, in closing, that's more or less the plug for you, the individual investor, to consider working with an advisor. Obviously, we'd love to have a conversation with you, but I'm really more or less making a plug for having a trusted advisor. Really does help you with the long-term success and mitigate some of those personal biases and things that we talked about. So maybe in closing, there is an evaluation form that we would absolutely love to get your feedback on. Thumbs up, thumbs down, less Dave, more Jason, more Derek, right? Without your feedback, we can't make this better. The other thing, right, for a plug from last year's webinar, we still have some of the Psychology of Money books from Morgan Housel. If you fill out an evaluation and you tell us you want us a book, you know what? We're going to send you a book. So that's maybe the carrot for those of you that weren't in last year's and would like a copy of that book. So in closing, we appreciate you spending some time with us this morning. I hope you found it enlightening, educational, and it was worth your time. And maybe in closing, to the extent that you'd like to see our content in the future, here's all the various ways that you can follow us and kind of see our latest thoughts and observations. So thank you again, and that concludes the webinar.